let's take a look at some different ways to aggregate our costs so that we can come to a better understanding of how our firm has performed. Here are all of the costs that we have to deal with. We have our direct materials and direct labor, and I've split our overhead into a variable portion, part that changes when our level of activity changes, and a fixed portion that's likely to stay the same within the relevant range. I've also split our marketing and administrative costs into a variable portion that's likely to change depending on how busy we are. That might include, for example, sales commissions, and then a fixed portion that probably won't change within the relevant range. So what can we do with these costs? Well, if we include them all, that's called full cost. And it's an important number because ultimately the goods that we sell have to cover their full cost in order for our firm to be profitable. But that's not the only way to understand these costs. A different way to look at them would be to cluster all of the manufacturing costs. That would be materials, labor, and the fixed and variable components of overhead. That's called full absorption costing, and that's what GAAP requires us to do because these costs are treated as product costs, whereas the fixed and variable marketing and administrative costs are treated as period costs. In that case, a traditional income statement would show sales revenue minus the full absorption cost for the units that we did sell, and that would give us gross margin. Any full absorption costs for units that we didn't sell will be capitalized on the balance sheet as inventory. Then on the income statement, we'll take the gross margin, subtract out all of our marketing and administrative costs, and that will give us our operating profit. Another way to look at these costs is like this, clustering the materials, the labor, and the variable portion of overhead. We find that for external financial reporting, we are required to look at costs in a particular way. But internally, it sometimes is convenient to look at costs in a different way. Here, these variable manufacturing costs are going to be directly proportional to our level of activity, to the number of units that we make, whereas the other costs will not be. So we can use this methodology internally to evaluate the performance of our production facility. Make sure when you analyze performance that you don't accidentally treat fixed costs as variable costs. Yes, we sometimes allocate our fixed costs to the units that we make, but that doesn't make those costs proportional to the units that we make. We'll deal with this issue significantly in a later chapter. Here's another way to look at our costs. We can cluster all of the variable costs. That would include materials, labor, the variable portion of overhead, and variable marketing and administration. This is a very common thing to do internally. So we could also make what's called a contribution margin income statement. In a contribution margin income statement, we take sales revenue, which is proportional to the number of units that we sell, and we subtract out all variable costs, which are also proportional to the number of units that we sell. And that gives us a handy number called contribution margin. That represents how much we have left over from our sales revenue after each unit has covered all of its own variable costs. Then we can take the contribution margin and subtract out all of our fixed costs. That would be our fixed overhead and our fixed selling and administrative. And that would give us operating profit. So let's take a look at an example and compute some of these amounts. Here's some information for the ABC Manufacturing Company, which made and sold 6,000 units last period. So the first question is, what is the full cost per unit? Well, we have to find all costs. That would be all the data that was given other than the sales revenue. Happens to come out to $42 per unit. Now compute full absorption cost. In that case, it would be all of our manufacturing costs. That would be our materials, our labor, the variable portion of our manufacturing overhead, which we're told equals $20 per unit, plus our fixed manufacturing overhead, which was $12 per unit because it was spread out over the 6,000 units that we made and sold. Now, what is the variable cost per unit? That would be all of the variable manufacturing costs and all of the variable marketing and administrative costs, $26 per unit. Now, what's the gross margin per unit? That would be sales revenue minus the full absorption cost per unit. In this case, that would be $60 of sales revenue minus $32 of full absorption cost. So our gross margin is $28 per unit. Now, what's the contribution margin per unit? That would be sales revenue minus all of the variable costs. So $60 of sales minus $20 of manufacturing costs that are variable and $6 of marketing and administrative costs that are variable gives us $34 per unit. This information does not tell us whether these numbers are good news or bad news. Remember, in order to decide whether something is good or bad, you need to be able to compare it to something, and we can't do that here. What we can do is to use this information to try to understand how our firm performed during the period. One way to do that is using full absorption costing. That's what we use for external financial reporting. So we're going to take sales minus cost of goods sold, and that will give us our gross margin or gross profit. And then from that amount, we'll subtract out our fixed and variable selling and administrative expenses to get operating profit. Alternatively, internally, it's probably a better idea to use variable costing. In that case, we're going to take sales and subtract out all of our variable costs to get our contribution margin, and then we'll subtract out all of our fixed costs. That would be fixed manufacturing overhead and fixed marketing and administrative to get our operating profit. And then the question is, are these two operating profits the same? I don't know. Let's take a look. Here is a format for preparing a traditional income statement according to GAAP. That would be using full absorption costing. So our sales revenue is going to be the 6,000 units that we sold times the $60 per unit selling price, $360,000. Now we need to compute cost of goods sold. This includes both a variable component and a fixed component. The variable component is comprised of the material costs, the labor costs, and the variable portion of manufacturing overhead. The fixed component represents all of the fixed overhead, which we believe is not dependent on the level of activity within the relevant range. So the variable component would be 6,000 units times $20 a unit. The fixed component, which might include rent, supervision, taxes, depreciation on the machinery, things that probably don't change with our level of activity, we had already allocated out at $12 per unit, and now we have to multiply back by the $12 per unit to determine what the original value was. In real life, information would probably show you that, and you wouldn't have to do the math problem. Based on this, our total manufacturing costs are $192,000. We can subtract that from our sales revenue to get our gross margin. Now we have to figure out our operating costs. That would include both a variable portion, sales commissions, and a fixed portion, salaries, rent on the corporate offices, advertising costs, and so forth. The variable portion is $6 per unit times the 6,000 units that we sold. The fixed portion we had already spread out, allocated to the units at $4 a unit. Now we have to multiply back by the 6,000 units to get the original amount, $24,000. Add that up. Those are our total operating costs. Subtract from the gross margin, and that will give us our operating income, $108,000. Easy. Now let's take a look at a contribution margin income statement. Sales revenue is the same, $60 per unit times 6,000 units sold. Our variable costs will include the variable portion of our manufacturing costs and the variable portion of our marketing and administrative costs. For manufacturing, that's $20 a unit times all the units. For marketing and administration, that's $6 a unit times all the units. Add it up, that gives us our total variable costs. Subtract our total variable costs from our sales revenue, and that gives us our contribution margin. That's a very interesting number. It tells us that after each unit has covered its own costs, it contributes to covering our fixed cost and giving the firm profit. So in this case, we have $204,000 above what the variable costs were to make and sell these units. Now, we don't get to keep all of that because we still have to cover our fixed costs. That would be our fixed manufacturing costs and our fixed marketing and administrative costs. So we have to back into how much our fixed manufacturing costs were because of the way that the data was presented. In real life, we'd know this number. And the same thing for our fixed marketing and administrative costs. Add those up, subtract that from the contribution margin, and that gives us an operating income of $108,000. Exactly the same as we had in the traditional income statement. Well, that's very nice, and this certainly gives us a different way to understand how our firm is doing. But my question to you is this always true? Is it always true that operating income will be the same on a contribution margin income statement and on a traditional income statement? And the answer to that question will be explored in another section.